Hey everybody, how you doing? It's Tuesday, March 15th at 3 p.m. Eastern, and I have my good friend Imran Laki here. Imran, how are you doing?
Hey man, how are you?
I'm doing great. It's been a wild few days here, and what's interesting from my perspective is that we write a morning note every day, and we put levels and key gamma strikes and blah 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 up there, and they've been the same level every day for like the last 5 days, even though things are going just bananas throughout the world, and the
Yeah,
equity market's kind of but obviously tomorrow's the Fed, which is why we want to talk. It's FOMC on Friday, FOMC tomorrow, and then OPEX, a lot of acronyms, on Friday. So our levels are going to change, our options levels are going to change, and and we are excited to finally get some new things to talk about and hopefully some movement in the equities market.
yeah,
Um, so with that, we want to start the conversation on something topical here, which is the VXX. Now, it's been moving like crazy. This is one of these things. Barclays stopped issuance of the VXX ETN, and that thing is going a little bit haywire, which is just kind of it's an interesting thing to watch. It's an interesting thing to see move around. But you and I both think sort of long term, there's not a big impact here. You want to kind of make a couple comments on that, and I'll bring up the old chart of it.
yeah. I mean, look, I haven't traded VXX for a while, if I'm honest, but I used to trade it a hell of a lot when I was in the banks. And
Mm-hmm.
my impression is whether if you're a client or you're a bank or whatever, and you kind of rotate. You trade VXX if the shape of the curve kind of suits you to do so, or you might just trade straight VIX futures, or you might trade options on VIX or options on VXX. And the truth is, they're all a vol proxy, right, to some extent. So if I don't really know why Barclays have stopped doing the issuance, right, and I suspect it's got something to do with their internal treasury and like their limits or whatever that they can do in terms of
Yeah.
issuance, right? So I suspect it's more related to that. In terms of the impact it has on vol, okay, the VXX product itself might dislocate away from where it should trade
Right, and
because
that's what we're looking
there
at
might
here.
be some people who are just short that product who can't trade other vol instruments against it and just have to get out and are forced to buy at the wrong price. But the reality is, I'm pretty sure there'll be people with the pockets deep enough to be able to sell the VXX at the wrong price, buy VIX futures, and carry that position until it normalizes, basically, right? Or even
Yeah,
S&P options, right? You can also buy S&P options if you need some volatility exposure, and all of these give you some of that vega that you need. So I don't think this is going to create any kind of crazy squeeze or anything like that in
yeah, and
volatility.
if anything, it's isolated now, right? Because they can't issue or sell the shares themselves, then they're not able to go into the futures market and buy the underlying futures, right? And kind of what's interesting, I guess, one of the things I want to talk about though is that they also stopped the oil ETF, and I think that what it seems like is they basically hit their share limit. They couldn't issue more shares of this. But in a way, I think it's also some de-risking. I mean, you have all sorts of markets going limit up, and I think a lot of these banks have unknown credit exposure really across the board, right? With everything in Russia and the chain link of oil going convex and everything else, right? And so, is this kind of one of these situations where you just de-risk a little bit? Um,
Yeah, I mean,
and
it's got a lot of echoes of what happened with the GameStop squeeze, right? So you had market squeezing. All of a sudden, all these brokers realized that they're not charging enough margin for this stuff,
right.
given the volatility of it. So then they stopped letting you buy stocks on the brokerage platforms, right? This is kind of the same thing, right? If they're not issuing any more of the VXX, I think, for oil, it kind of makes sense, right? Given what was going on in oil, vol went to like 80%. All hell's breaking loose in terms of intraday volatility in oil. You can see why a lot of people would just kind of want to ramp up margins and kind of degross all the books. And I think that's partly what's been going on this week with the whole commodity sell-off. I think there's a lot of de-risking going on
Yeah.
where people are just saying, you know what, my margin requirements are going up. I don't know if my trades are going to get cancelled if the movement's too extreme, like what happened on nickel and LME. So why don't I just de-risk the book a bit and wait for the dust to settle, right? And I think that's what's going on.
Yeah, and to this point, this came out on the 14th yesterday, which I just thought was curious. I mean, I don't. It's just a little bit weird, but basically SEC comes out and reminds brokers to basically make sure that everyone's got enough margin. It's just kind of this funny little statement they made, and I guess it's good. Just remind everybody that basically your margin's only as good as your broker's margin, right? And that's basically how Robinhood blew up last January, and then also why the LME shut trading for 5 days, right? Because there were some brokers that didn't have enough margin. So I think that gets lost on people a little bit, and is a good point for you to bring up. But I also saw this was probably one of those correlation, not causation things. But Barclays certainly has outperformed a lot of the bigger banks over the last, yesterday and today. They had a bigger pop. A lot of the financials are so. Some of these other banks, I think, I was listening to another podcast where they're talking about, looking at the bank stock performance as a way of sort of figuring out what type of exposures these guys have overseas and some of these other, Russian ETF and things like that. And this is kind of funny. I mean, there was one closed-end fund. I mean, I realize this is completely off topic, but that I was looking at in this closed-end fund, it's a PIMCO fund. And because they had gotten heavily into Russian CDS, I believe it's about $1 billion or so notional exposure. These ETFs are just getting crushed, right? Because everyone's not sure where the bodies lie. And it's
everyone thinks Russia defaults, right? Everyone thinks that's inevitable.
That's what everyone thinks. And so tomorrow, Wednesday is their day. They're supposed to start paying, and I think it's only $115 million, I believe, is what the headline was. Right. But right, and so that gets. I think they could probably muster that, right? But so they have 30 days.
They're going to pay it in rubles, though, right? So
or yuan, I guess. I don't know.
They're going to pay it in rubles apparently because their assets are frozen. Right. And then then there has to be a decision on whether that's a technical default or not, in terms of our CDS is going to pay out and stuff like that. So and we won't know that for about 30 days. There's like a grace period of 30 days. So all kinds of shenanigans going on in the credit market, which we won't we won't know where the bodies lie until this stuff actually gets decided on, which will be after like a 30-day grace period. Right.
So they had that other 30 days. So it kind of kicks the can a little bit, right? I mean, it's going to bleed out a little bit, kind of like the LME pausing for 5 days. And I don't entirely know what's going on. And that is a good segue into one of the kind of big things we're talking about tomorrow. So we got the FOMC tomorrow. I have the Fed tool up here on the CME. Consensus is 25 to 50 bips. I think 25 is kind of what everyone is leaning on, right? Is basically what everyone is pricing. And the question is going to be how many hikes, what's the other part of the narrative. So this is a little bit more your area than mine. So what are you kind of looking for tomorrow with the FOMC?
Well, I don't think the 25 bip hike is going to surprise anyone, right? That is nailed on. So really what we're looking for is indications on the pace of the future hikes. What are the dot plots going to do relative to what the market's pricing, right? So on that page you're just sharing, if you go to the probabilities page, there's a tab on there called probabilities. Yep. You go to that, and then you see what probabilities they've got for May.
Mm-hmm.
They've got around 50-50 basically for whether May is going to be a 25 or a 50 bip hike, right? So really we're going to be looking for indications of how likely it is May's going to be 50. And is 7 hikes for the year, is that really what the dots are going to kind of reflect, or anything like that? And then, what about balance sheet runoff, QT type stuff? What indication they give us? But is any of this getting softened by the fact that the Russia-Ukraine war is happening? It's created all kinds of madness in commodity markets and maybe throwing us into some sort of global recession. Is that softening the Fed in any way? Or are their hands completely tied and they just have to get inflation under control and they're going to put their blinkers on and just hike like a madman? Right now, we don't generally expect that from the Fed, but the Fed's never had to deal with inflation like in double digits, right? PPI came out at 10% today. That's insanity, right?
Right.
I mean, so we're in a very different regime and one that we haven't seen arguably since the 70s. And that was long before any of us lot were trading, right? So let's see how this works. But I'm not particularly bullish for the FOMC. I mean, I think the market's a bit bared up, and so there is definitely squeeze potential on headlines, but I think those headlines need to be more out of Russia, Ukraine. I think we're going to struggle to get a really positive move out of the Fed, personally.
That's interesting. I mean, and it highlights kind of, I think, one of the problems just with in the investment space is there feels like there's not a safe place to put your money, right? This year, and keeping it in cash with 10% at least inflation is also kind of punitive. So it's a challenging environment, I think, for a lot of people to invest in and wade through this environment.
Yeah, no, I agree. I mean, I have been raising cash in my pension portfolio that I manage myself. Um, it's been okay because I've had a heavy allocation in commodities, right? So that's been the saving grace, right? So I've been relatively light on bonds. I kind of de-risked a lot of my equity exposure in December in terms of US equities.
Mm-hmm.
I did keep some EM, thankfully not too much China, but I did keep some sort of EM type exposures in equities, which have not made money but haven't killed me. But it's like in that move in commodities in the last few weeks, I had to take some money off the table, right? Because that had just performed, that had just done its job and some. And I
Yeah,
was like, okay, let's switch some of that into cash and let's wait for the dust to settle. Because it's hard. It is. I get what you're saying on inflation, but the truth is, it's about asset price inflation, right? If you don't see asset prices ripping from here, then you'll be glad you held cash because you'll be able to buy assets at a cheaper price,
that's right.
right?
Good point.
So yeah, so provided equities keep selling off, you'll be very glad you're in cash. You don't give a shit what the inflation prints are, right?
Yeah.
Mm.
And I'm
Yeah,
flipping through some of the energy names here, and then they had unbelievable runs and just unbelievable unwinds really over the last
yeah,
2-3 days, and whether that's because the Venezuelan government is suddenly a good friend of the United States and going to start producing oil, or COVID comes out of Shanghai and that's a demand supply issue now. Who knows what it is, right? But that seemed to come down, and arguably that was, I mentioned that in the note this morning, that was one of the stools propping up the S&P. I think a little bit here was energy, was get the sector rotation, right? Energy's doing well, metals, et cetera, and suddenly those kind of get kneecapped a little bit, and have given back some. So that is really quite a lot of volatility there.
yeah. I mean, the vol in commodities is crazy, right? So I was having a look at this. I think I might have tweeted it, or I certainly shared it with my subscribers. But you had wheat vol go to 200. You had
Yep.
oil go to 80. You had gold vol go from 15 to 30, so doubling. And then they've retraced massively, right?
Right.
Wheat's back to about 100 from 200. Oil's gone from 80 to 60. Gold's gone from 30 to 20, right? Which is pretty brutal. A move back down in vol. So yeah, and even gold spot prices, right? After just touching near those all-time highs at 2070, they've come crashing back down to like 1920, right? In short order. So puffing all those people back into gold, thinking, okay, that's the safe haven, that's the safe haven. It's going to 2,500. Goldman's came out with a report calling for 2,500. Their timing was impeccable, and now it's absolutely hammered again. I mean, I do think there's a very good long-term case that central banks are going to have to diversify more out of dollar reserves and more towards gold, right? And you're starting to see, countries trying to trade oil and commodities outside of the dollar. So I do think the recent sanctions and stuff are going to act as a bit of a catalyst towards people wanting to get away from the dollar standard to some extent. So I
Yep.
do think that is longer term good for gold, but my God, in the short term, it's a bit of an animal to trade.
Yeah, and that vol is something else. I mean, we put a similar chart up of just the GLD, the ETF implied vol, and how much that has moved. It's a March of 2020 type move. A lot of these things are without and that's without sort of the devastating sort of lockdown and energy crisis, right? I mean, it is an energy crisis, but back then it was a credit crisis, right? And everyone didn't know literally is the world stopping here,
Yeah.
and here we are with. Yeah, there's clearly a lot of geopolitical issues, but the vol ratcheted up, so much more quickly. It feels like than in March. So moving on a little bit here. So we're gonna get the FOMC. You're a little bit bearish coming out of FOMC. I think a lot of people are. Our view that we've been talking about for a while is that we think implied vol will come down a little bit, or will will flatten or deflate a little bit, however you want to say it, based on the fact that the Fed is going to tell us finally if they're going to raise and how much, and then give us a little more clarity on what they're seeing forward, and that should decrease implied vol a little bit. Sounds like you're more of a Fed's going to upset the apple cart here and keep vol sustained, and then that.
I'm
Yeah.
not sure about that. I mean, I do think there'll be a little bit of a vol reset because obviously vol's pretty pumped, right? And this always happens. You go into one of these major macro events, everyone's anticipating it. No one wants to be too short vol, and then everyone's letting go of their options that they don't need anymore, right? And stuff like that. But I just feel that the base level of vol in equities is now going to be a bit higher, right?
Totally agree with you.
We're not in the same vol regime that we were. Like last year, the floor in vol in VIX, let's say, if that's your benchmark, was around 15. I think the new floor is probably 20, 22, something
totally
like that.
Agree with you. Yeah.
And it's because the economic volatility is so much higher, right? Like what's going on in inflation is just nuts, right? It's like we've not seen this for decades. And, policy pivots. Obviously, the Russia-Ukraine stuff is particularly topical right now and creating all kinds of turbulence under the hood that we haven't even figured out yet, right? What are the liquidity consequences, right? What's going on in the funding market? There's various people who really understand the plumbing of that, like Zoltan Pozar at Credit Suisse, and he's saying that commodities is like collateral against all these things in the financial system, and with all these bottlenecks and all these sanctions and stuff like that, you're seeing some serious problems on that front. And that could then lead to some sort of contagion and some real issues for the market, right? So I don't know how right or wrong he is, or how long that stuff takes to transpire, but I don't see us going back to a sub 20 VIX world until that stuff gets resolved, and I don't think that's getting resolved in a hurry, personally.
Yeah, I absolutely agree with that. And one of the things I found interesting was that, if you look at realized vol, which I have kind of queued up here, this is from the S&P. This has been a fairly sustained grind higher in realized vol, right? Obviously the market is moving quite a bit more now. We never kind of got this limit down move that, really was like the puke kind of capitulation. Through the entire sell-off of January up till now, it feels to me more like it's been a de-risking, kind of degrossing, whatever you may want to call it, situation where people know rates are gonna go higher. There is a little bit of a geopolitical, obviously, tail risk here, but the regime has shifted, right? The regime has changed, I guess, is what my point here. And then, kind of in line with this, this is again from the CME. This is the liquidity tool they offer for the E-minis and a lot of these other futures products. And so what this is showing you is the book depth of the E-minis. And as you can see, I only charted this back to February of last year, but the liquidity has evaporated. And before you say this is just strictly due to the Ukrainian conflict and risks associated with that in the credit market, the deterioration started with the market near all-time highs, right? And this is back to when they started talking about tapering. So I don't understand the mechanics of exactly why depth of book would go away in E-minis when we start talking about tapering. But there's a clear, again, a regime change. And when there's less liquidity to get a fill, you got to pay more spread, right? You got to push the market more, and that invokes volatility. And that ties in again with this realized volatility that we're looking at here, and obviously sort of VIX if you just use that as your high level view of volatility.
And you've had cross asset vol exploding. Obviously, we've talked about commodities, but you look at the MOVE index, right, which is the interest rate volatility. That's at multi-year highs as well, right? You've got
this move here basically took out, or I understand this is a volatility index, so it's not the same, but these are the March level moves, right? In this bond VIX, and this is when the S&P was down 40-50%, right? And that's sort of my point here is that these are the people are seeing the risks of 2020 in the credit markets. Or the hedging level, right? But we're not quite getting those moves as of yet, at least in equities.
Yeah, and I think we're not getting them in US equities, but let's be clear, like European stocks got battered like 2 weeks ago to the point where VStocks, which is your European VIX equivalent, went to 65, right? That's like it was trading 25 vols above VIX, which is unheard of, really, right? I mean, so it was very stressed, I would say, right? It's just that to some extent, the street got caught long Europe. Everyone thought Europe was going to do all right this year. They were going to have like a stronger growth impulse coming out of COVID because they restricted people harder than the US did. You were seeing an uptick in the PMIs. People were trying to invest in where value was, and Europe was clearly one of the value trades out there. So people came in consensus long Europe. Then Russia, Ukraine happens, everyone shits themselves and has to puke out of Europe. And you see like a 7 billion outflow in a week, which was the biggest ever measured outflow from Bank of America. And that just caught everyone wrong-footed, basically, right? So that's what happened in Europe. But I think some of that outflow of Europe was then met with buying of US because they got to park their money somewhere, right? So that switch back into US is partly why the US market hasn't sold off as aggressively, and the VIX hasn't been able to spike as aggressively because there's been some switching back to US safe haven kind of assets, because even though, US will get impacted by all these kind of energy prices and food prices and stuff, they're still going to get less impacted than Europe is, right? And some of like emerging markets and stuff are. So it's that kind of US exceptionalism trade, that sort of safety trade back into US assets. I think that's partly the reason why you've not got this that real acceleration involved.
And as a guy who sits in London, I guess you have a more interesting perspective there, because typically we just sit here and watch the U.S. markets all the time and say, "Who cares?"
Yeah, well, I told my subs to like sell European strangles to buy S&P strangles like a week or two ago, because that just got completely ridiculous.
It's a smart move. I was thumbing through some of the iShares various country indexes, and I mean, in particular, the one that really catches your eyes is Hong Kong and China. I mean, holy cow, right? That's
yeah, you can't touch that with a barge pole, I don't think, because
no,
anything with that amount of regulatory risk and potential now for capital flight because of if China are helping Russia out, then what the hell kind of sanctions are people going to put on Chinese assets?
Yeah.
And even if they don't put Chinese sanctions because they don't want to rub China up the wrong way too much, well, what's going to happen in terms of self-sanctioning? A lot of this Russia stuff is self-sanctioning. I mean, I've never seen anything like it, right? That people are basically out of political correctness almost self-sanctioning anything to do with Russia, right? I'm not saying that they deal with Russia, but it's just pretty interesting to see that dynamic because I've not seen that before.
Yeah, and you again, you just don't know. I mean, the markets aren't even open, right? So in a lot of these cases, so you can't. There's no price discovery, right? I mean, obviously, like Russia obviously closed, so anything related to Russia is closed, and and so you can't figure out, you can't assess exactly what all is going on. So, kind of related to the volatility conversation, do you follow the VVIX at all, the vol of vol index?
Yeah, I do look at it, and the VIX ratio. That's something our mutual friend Darius looks at quite a lot. Right?
Yeah. So someone here asked, based on the level of vol, what do you think of the VVIX, and you think that'll go back to like a sub 100 here?
I mean, the VVIX is coming down, right? So it's come down from highs of
has come down, yeah, quite a bit. Yep.
150, 120, right? Yeah, I mean, remember, I think the point here is that what often happens when markets get stressed like this is that people basically say, right, I don't need to buy calls on VIX, right? Which is kind of the main driver of VVIX, is kind of that call option flow on VIX, right? Because that's your tail hedging flows in VIX options. That's where the higher vol strikes are. So if VVIX is really exploding, it's usually because there's some kind of upside call buying going on in VIX, which is some type of hedging, right? But upside call buying in VIX is a fairly low conviction hedging strategy, right? It's like I'll spend $50 or $1 and I'll forget about it and I expect it to lose money. But if the world ends, it will bail me out. Okay.
Right.
Now, when you have higher conviction that the world might be ending, you don't buy those, right? You just buy VIX futures because you have so much more conviction that I own VIX at 2025 or 30 now, right? Or whatever it is. Okay, it might drop 5 points. I can live with that. but it might go up 30 points. So
Right.
the futures, the VIX futures become your kind of trade, your preferred trade, because they have the risk reward, right? They're not futures that are just rolling down through the contango and bleeding and
Yeah.
are very unlikely to pop. They're now, okay, we're in a shit world. Things could get a lot shitter. I think the vol base is now higher, like we just said. Maybe it's 2025. I'll own some vol here, and if the world does end, this VIX is going to 50, 60, whatever. So that kind of optionality kind of moves over to the futures side, and you don't need to then buy optionality on the actual VIX options. VVIX kind of comes down. That's kind
That's
of how I see it.
that's very insightful. That's a very useful explanation there. So thank you for that. And that the VIX expiration, someone asked here, that was actually this morning. So VIX is expired now. It's forward 1 day because there's Good Friday, I believe, in April. So they had to shift. They bump that expiration forward. And kind of, I guess we can segue that into the OPEX expiration. We're getting a lot of questions on that. So we'll just quickly forward over to theirs. I know people need to start trading the close, so we'll keep it shorter here. But our view, and we've been writing a lot about this, and Imran, feel free to agree or disagree, is that there's so many large put options on Friday, expiring Friday, that we think this is going to be a typical OPEX bounce, right? OPEX induced bounce. Now, we described that we think there's a little bit of path dependency in how the market reacts to the Fed, but basically, if the Fed sort of makes everyone happy, or at least doesn't spook the market too much, we're going to start burning up a lot of these puts. Now, this is our delta tilt indicator, and what this is showing is the amount of put delta against the amount of call delta in the market. And as you can see, the fact that this indicator is all the way down here at the bottom is telling us that there's a lot of deep in the money puts. Those are delta heavy put options, akin to those of December 2018 and also March of 2020. And so in theory, there's a lot of short delta hedges on, short futures, short whatever it may be, hedging this put exposure. And on Friday, those puts all get wiped out. Historically, we've seen the Monday after OPEX be a low. Now, because the Fed may kind of trigger a rally here, again, that's where the path dependency comes in. The Fed may trigger a rally, which lights a lot of these puts on fire first. But this is the main reason we've been really looking for a rally in market. It's a technical positioning discussion, so to speak, or view. And that really is why we're primarily looking for a reason in the market. Puts are very expensive right now, and please comment on this, but it's expensive to buy a put option. If you want to hedge downside right now, you're paying a lot for it, right? Because everybody else is also long puts. Not a lot of call action. Not a lot of people looking for a big bounce in markets. And again, with vol so high, do you even want to buy calls? It's a tough predicament, obviously, because you're going to get a vol crush if the market starts to rally. So, what are your sort of comments on that? Again, agree, disagree? What's your perspective?
Yeah, I mean, on that last point, call spreads, call ratios, call flies. That's the only way to get long, right? You can't buy calls in this environment. You'll get your view right, and you make no money, basically, right? So it's
right.
pointless.
And so, just to be clear for everybody, when you write the ratios or the spreads, by selling those other calls, you're offsetting hopefully some of that volatility decay, right?
Yeah. So call spreads are your kind of safest thing to do. If you want to get a bit more aggressive, you do call ratio type structures, which actually get you short vol on a rally. So you're looking for not only a rally in spot, but you're looking for vol to get crushed, and you benefit from both those Greeks. That would be a call ratio. Hard for retail people to do just because of margin requirements and stuff. But call flies are a similar structure that retail can participate in.
Right.
On your whole OPEX idea, I mean, yeah, look, it's one of those things. I feel like there is a bunch of put protection, I agree, to March, okay? And I don't know where the big strikes are, but I think they're all the way down to sort of 4,000, basically, right?
Yeah, that's what we're looking at here. So 4,000 is kind of the beast, but what's interesting, and I can pull up this chart, is that there's a lot of, again, deep in the money puts, and those are likely held by big institutions who don't roll them, right? They hold them to expiration, and then like that JP Morgan thing on expiration day or whatever, then they roll it, right? It's a mechanical operation. It's not like, hey, these puts are in the money, great, let's close them,
Yeah, but like those things are just going to be offset by some March futures by now because they're fully in the money, right?
Mm-hmm.
So think about it. If the client's got those on and they're happy to let them die and expire, right? the dealers got March futures against the option, and then both those things die. So they all, so there's no incremental trade to do, basically, right? Because you've got the futures. I suppose the guy who sold the futures has then generated some cash to sell, some cash baskets to sell, and then if the client lets it expire, then maybe there is some buying back of that cash basket. Yeah.
Yeah,
So
it's a murky chain of events, right? Because on the face of it,
yeah,
I agree with you, and it's sort of like someone's hedging the hedgers hedges. You know what I mean? It's like there's a chain of events. Who are the bank? You know, who sold Bridgewater the puts, right? How did they lay those off, et cetera, et cetera.
yeah, but I don't think if I'm a client and I'm long a load of March in the money puts right now,
Mm-hmm.
maybe I don't want to buy expensive June puts because vol's so high, right?
Mm-hmm.
But my March options are not really options anymore. They're just in the monies, which is effectively futures, right? So you're telling me I'm a client, I bought some puts in March, they became 100 delta, they now behave like short March futures, and I'm going to let them expire in March just because it's an arbitrary date when Russia Ukraine's going on and the world's imploding. I don't think I will. I think I'll roll those into June futures.
one Hundred
I won't
percent.
roll them into June options, but I'll roll them into June short futures,
Mm.
right? Because that's effectively what they are. They're a 100 delta option, which is no different to a futures position. So I would think that whereas you may have had some people in March 2020 letting their hedges expire because the market had a ridiculous sell-off, they effectively monetize protection, and then there is effectively some buying to be done when those puts are allowed to expire in the money intrinsically. I don't think hedges right now necessarily that have gone in the money. If you've kept your hedge on up till now, you're probably still going to keep it on, right? But you're going to have it in futures, not in options, because like you say, the vol's expensive, and you might wait for a correction in vol to then do June puts again or whatever it is.
Right.
But I think you might be rolling those March 100 delta options into June futures, and then you won't get an incremental buying impulse from that expiry, basically, right? So
It
there is
removes
that.
some of that gamma. I mean, I totally can respect that view, and to say that it's easy to trace the all the links between rolling these options down and out. I mean, on the face of it, if you just say, hey, look, I'm going to roll out to June, you're going to roll to a lower strike, right? So there's some delta exposure there, but you're right. Maybe they say vol's too expensive here. I mean, just again, if you look historically at and I'll pull back this chart here quickly, but if you look historically at where these bounces come, right, it's tied to these big expirations. So, that is the basis for our call. This time could be different because credit markets and the Fed makes things upsets, a lot of the standard positions, or vol's too expensive and people don't want to pay it. But there is a lower bound in our historical data, and we appear to be at one, which is sort of the basis. It's a positioning basis for our call.
The pattern. I mean, the pattern is there. I just feel like in previous quarterly expiries, we haven't had all these other things going on at the same time that could throw a spanner in the works. And
Well, I mean, I would argue that in March of 2020 there was a fair amount going on. The Fed did come out on that Monday.
Yeah, but I say the Fed came out on that Monday and basically backstopped the credit market, right?
Yeah, and Mnuchin called all the banks on the day after OPEX. So maybe these guys all know that's where there's an expiration in there. And
if after March expiry we suddenly get a ceasefire, same thing's going to happen, right? That's
very good. And if it happens on the Monday after act, and you say, look, this is like we might as well just follow the moon cycles or something, because just good news.
But I think the ceasefire is the news the market needs to have a real rally, because then VIX can go back towards 20, right?
Yeah, and I would agree with that. I mean, for a while I was saying that most people had put hedges on because of the FOMC. They initiated hedges, and then from an equity perspective, and then when the incremental geopolitical news picked up, they didn't need to sort of add more hedges because they were already kind of hedged out. But the credit markets really started to fall apart in a way that I wasn't anticipating. Kind of when I was saying I think that the Russia. I mean, at the end of the day, Russia is still kind of like you say, it's a tail risk. or something I think we're going to deal with, a few weeks out here. The chart on your screen is from Goldman. This is the notional value of all of the options that are set to expire. I mean, you see this big bump here. If you can see it on your screen, I'm around, it's small for you, but that is the 4,000 strike. There are around 100,000 puts on the 4,000 strike that are set to expire, and around 90,000 in the money calls that are also set to expire on Friday. So that's a very large position. But you can see that most of the options that are positioned right now with puts they're in the money puts, right? These are puts that were put on obviously several weeks or months back, and so notionally there's a lot that is set to expire there on Friday. And again, this leads to sort of our last point. This event will wipe out a large part of these put positions that are in place now. And vol is high. If we do get a relief rally, 4,500 in our view is kind of this obvious strike overhead, particularly due to the big positions there related to the quarterly expiration for the end of March. And if vol comes down, implied vol comes down, we have all these puts underneath that are wiped out. It could start to make more sense to start buying some put options if vol comes down and the market rallies a little bit, right? That could be an opportunity for people to start to add protection. And it certainly is going to remove a lot of the put positions underneath where we're trading.
Yeah, I mean, totally. If you get a squeeze up to 4,500, that's a great opportunity to set up more bearishly for longer term horizon, whether it's June or September, I don't know. And then if you get a leg lower down towards that 4,000 area, often those kind of cliffs in open interest do act as a bit of support, basically.
Right.
So I think taking a tactical call spread type trade on, if we were to touch 40-50 or something like that into April, is probably an all right trade, because we're probably going to have some sort of reaction off that area, I suspect. Right?
Yeah, so, and psychologically, it's a big round number, which oftentimes people seem to pay attention to as well. So that is and you can see again on this chart here, this is the gamma currently at that strike. So who knows, Fed may come out and really upset people, and I think we could get a drawdown to that 40-50 to 4,000 level pretty quickly, right? That's only a few percent from here into OPEX, which sets up another interesting situation, because you've really kind of, in my view, pulled the slingshot back, right? With put values, vol would probably be pretty jacked up. There's even more deep in the money puts now expiring, and so does that sort of invoke a short cover rally of some sort on next week? So to be determined. So I think we should probably wrap it up there, Imran, because we're about 20 minutes to the close, and so a lot of people got to get back to watching their books here. Before we go, do you want to tell people how to get a hold of you? I know you're running a boot camp here. You want to mention that?
Yeah, sure. So I'm options_insight on Twitter. I obviously provide options training content. I've done a course with the guys at SpotGamma called The Hedge. So that's our kind of joint venture. I also do live boot camps. My next one's coming up on the 26th and 7th of March. So not this weekend, but the one after. That's basically a Zoom course where I enroll people and I give them live training via Zoom, my whole syllabus of options, very practical, not really textbook theory, but much more about the practicalities of options trading. So if you're interested in that, reach out to us on our website, options-insight.com, and we'll explain and we'll give you more details.
Thanks for that, Imran. And for those of you who don't know me, obviously you can reach me at SpotGamma on Twitter. If you're interested in our daily notes, we'll be talking about the markets here every single day. Obviously, we do that anyways, but these next couple of sessions are really quite interesting. If you go to subscribe now on the SpotGamma site, you can get a free trial for 7 days. Costs you nothing to see how we see the markets move over the next few sessions. And then lastly, we just launched this hero indicator, which shows all of the options trading in real time. If you check out our YouTube channel, we've gone into this in depth. But if you just kind of want to see how deltas are trading at the moment in the spiders, for example, you can load this up and you can see that we've had some pretty bullish options flow. The total delta readings so far today are positive about 400 million in spiders. And I think Qs, we had a big put spread trade earlier this morning, and it's been a little bit more neutral sort of order flow in the Qs for the remainder of the day. So that comes with the free trial there. And we will leave it at that. So Imran, thanks very much. And at a minimum, we'll be talking to you next month for April expiration as the year is flying by.
Yeah, good to see you, mate. Take care.
All right, buddy. Take it easy.
See ya.